Okay, that's your interpretation, but his interpretation different. All of them are world, right? So, that's
Crazy story.
yeah.
So this week, we are very happy to have Max presentation and the stage is yours.
Thank you, Martin. It's great to be here. I can't cuss or anything because this is being recorded. So, hello, Adam. Hello, Andras. Hello, Laszlo, and everybody else, my old friends. So this is a paper similar to the kind of work I've been doing all my career of monetary economics. It's called a present value explanation of interest rates through inflation tax avoidance. So this is with Thomas Chabafy. He and I did most of the work, and Mikhail K helped some, and Kerry Davies. It goes back to his PhD's dissertation, and he stayed on the paper. So in this first slide, it's a summary of the whole paper. Okay, so it's motivating it and telling you what the paper does. I guess the subtitle is Money, Inflation, and Interest Rate Pricing Kernels. So it's going to explain the real US interest rates, the 3-month Treasury bill rate, the short-term rate, with a monetary real business cycle theory, RBC model. So an RBC model has just productivity shocks in the goods sector, and that explains a lot of the features of the business cycle. So this extends it to a monetary world. And it's going to focus on the equilibrium condition that gives you the interest rate. And of course, we call that the pricing kernel, just the fancy language for the equilibrium condition that gives you the interest rate. And it's coming from this general equilibrium model, which is a rational expectations model. Now, the reason I put in rational expectations is, you know, the new Keynesian models have a optimization problem, but then they add in what they call plots that don't come from the single optimization problem. They just add on equilibrium conditions to the model. So a rational expectations model is unlike that, where it all comes from one optimization problem and the set of equilibrium conditions that implies. Fair enough? That's what that means when you say rational expectations in this context. And the exchange credit is the way that I'm going to endogenize monetary velocity in this model, so that there's a substitute. There's money, where if you hold money, you lose the interest that you could get if you invested it. But if you use instead, when you pay for things, credit, like your credit card. So it's very simple exchange. I call it exchange credit because it was called that in the literature. But just say you're a credit card that you don't have to pay off till the end of the period. So during the period, you can earn interest on that and avoid the inflation tax. So when you have an optimal decision of how much money to use and how much exchange credit to use, you endogenize the velocity of money, because money, you're not using all cash. If you used only money, the velocity would be 1. If you use less than that, velocity is defined as, you know, the total consumption over the money. So if consumption is bought with money and exchange credit, then the velocity that divided by m is greater than 1. So at the limit, it's 1, or it's greater than 1. Okay. So I'll talk about exchange credit a lot, how we model that. But you can think of this as, you know, your credit card you pay off at the end of the period, and money that you take out of the ATM machine, and so you hold and you lose interest on it. So then the thing that we do, which is following finance theory, is we get the long run solution of the interest rate equation, the pricing kernel. Because this is a first order difference equation. It has the current period interest rate and the expected next period interest rate. So, you know, it kind of looks like a Taylor rule. And you could interpret it that way. This interest rate equation is one way to derive what looks like a Taylor rule in general equilibrium, but it's got nothing to do with a Taylor rule. There's no central bank trade-off, separate central bank problem. It's got nothing to do with that. But, you know, so I'll mention that. And you know how a Taylor rule has a lagged interest rate term. You have a regular term and a lag term. So this is an interest rate and the forward term. And so to solve the long run, you can, you know, do that by, you know, these lag operators, solve forward and get the long run solution to, you know, it's like a fixed point. If you have a difference equation, right, Andras, and you get the fixed point, that's the long run solution. So that's what we're doing here. And then that was done in finance theory by Campbell and Schiller for the equity return, the return on equity in 89, a series of papers they did in 88, I think 87, 88. I'll have that on the next couple of slides. And they estimate this long-term solution with vector error correction model and with co-integrating vector they find. So we do that and we get a co-integrating vector and then we interpret the results. And for example, this co-integrating vector, because we include both consumption and leisure in the utility function, that means that leisure could enter into the co-integrating vector. Now, normally in the co-integrating vector, like in the Taylor rule, you only have consumption, but we find that leisure is very important. And we measure leisure as the percent of time that people are not working. I'll show you how we measure that. So what we find by doing the vector error correction model is this discount factor. And this is what they call it in finance theory. It's not like your rate of time preference discount that we do in economics. It's a discount factor in terms of the error correction model that modulates how the shocks say if it was the equity price, the shocks of the equity price move around the fundamentals, which is the dividend to equity price ratio in Campbell and Schiller. Here, the fundamentals are the consumption, the rate of growth of consumption. That's in your classic pricing kernel, the stochastic discount factor, we call it. So we show that we movements around the fundamentals through this discount factor. And the discount factor is this endogenous variable that's solved and has economic meaning. And essentially, it's the degree of inflation tax avoidance. I can even graph it. I mean, we graph it. And so monetary policy and banking insurance policy can affect the magnitude of this discount factor. And the bigger it is, the more the shocks fluctuate around the fundamentals. The smaller it is, the less the shocks. So it determines the bound of shocks around fundamentals. When there's a lot of inflation and a lot of inflation tax avoidance, a lot of credit, exchange credit use, high velocity, and then the discount factor is bigger and you have greater fluctuations. And so the money supply growth rate That's the main policy variable of the model. Is high, then you're gonna have a high discount factor. Now, in contrast, if you let there only be a cash in advance economy, so this is the cash in advance economy of Lucas 1980, where you only use money to buy consumption goods, then the pricing kernel, it reduces down to fundamental zone. So even though you have money in the model, you get the same pricing kernel of Lucas 1978, in which there's no money in the model. Only fundamentals determine the real interest rate. So it collapses. You don't get any of the results. So that's why exchange credit and the endogenization of velocity is very important. Okay, so that's more or less the whole paper. So we have this financial wedge in the model. And as a result, in the pricing kernel, you have to anticipate the future effective inflation tax. That's what gives the model all of its content. Because if you had, for example, if there was no exchange credit, that result doesn't follow. You don't have to anticipate the future inflation tax. Why? Because the future inflation tax is this combination of money and exchange credit. And that's endogenous, and you have to determine how that's going to be affected by monetary policy. So I'll show you that. Of course, mathematically, it will make more sense to you. Okay, so when you use the fundamentals only model, like there's this Canzoneri, Diba, and Cumby paper, where they, and that's what motivated a lot of our interest in this model. They look at the interest rate equation with fundamentals only, and they say they try and estimate it, and they say it doesn't match the data. And so the standard asset pricing kernel has failed to explain interest rates. So that's the puzzle, that's the problem. That's what we're solving. Now, the thing that we're building upon that you find in the literature is that a lot of literature now is using this shock-induced departures from fundamentals. There was this guy on exchange rate who won this prize. It's a Japanese guy on exchange rates recently. I think it might have been the under 40 prize. He's got a bunch of papers on explaining exchange rates through departures from fundamentals. I probably have them in the literature review slide. Oil prices have been explained as departures from fundamentals. Housing have the new research head of research at the Federal Reserve Bank of St. Louis. He does a lot on housing prices, and he had an AER paper using departures from fundamentals for housing prices. You know, what are the fundamentals of housing prices? The rents, but you have a lot of variation around the rents in determining housing prices. You can think of these as departures from fundamentals. If only rents determine house prices, you would have this departures from fundamentals. And other asset prices have been suggested can be explained in the same way. So this present value finance theory embraces the deviations from fundamentals. And that's what we're going to use. So this Campbell and Schiller 8788, we follow that very closely, except their discount factor is not, it's just a something they estimate. Okay. So we're going to formulate a new macroeconomic theory of these interest rates. based on shock-induced departures from fundamentals within the present value framework tested with vector error correction. That's a summary of what we do. Okay. All right. So before we get to, see, now I have a lot of talk before I get to the model. So it depends on your preferences as to where we want to spend the time, right? Now, how many of you like the math? Okay. Okay. So I don't have to go through all of these slides in depth. So I'll kind of just buzz through these. So it is a quantity theoretic model. And what's a quantity theoretic model? It means that, you know, if you increase the money supply a lot, then the inflation rate goes up. And another way to view what a quantity theoretic model is that you have a downward sloping money demand function. And that's what you get when you endogenize velocity. Now, no, you don't have a downward sloping money demand function if you don't endogenize velocity. It doesn't change with the interest rate, how much money you use. So the quantity theoretic downward sloping model is only when you endogenize velocity. So we're going to do what was originally an RBC approach to producing exchange credit. King and Rebello in a 1984 paper said, well, why don't we just produce this exchange credit like we do the goods sector with labor and capital? And the problem is that you don't get a unique equilibrium between money and exchange credit if you do that, because the marginal cost of credit is constant and the interest rate, which is the marginal cost of money, is constant. So there's no unique equilibrium. Now we're going to add, following a microeconomic banking literature. It actually started in the same year in 84, 85 in Journal of Money, Credit and Banking, a model by Clark, which really went back to a 77 model by Lindsay and Seeley, that you produce all the services of the financial intermediation sector using labor and capital and the deposited funds, right? You don't have any banking without the deposits. So that's what we do. And by doing it that way, you get a unique equilibrium. And I'll explain that. So the setup here is that the agent has all the income automatically deposited in the bank. You can call it a financial intermediary. And then buys consumption goods only with money and exchange credit that they withdraw from, you know, the ATM machine, or they pay off at the end of the period so they can earn interest on it. So you do get this bottom line says your amount of deposits that are in the bank, all your income goes in there, have to be greater, okay, minus your investment. So all your income minus the capital investment goes into the bank. And that has to be greater than or equal to what you can take out in deposits to pay for your consumption goods. So this is like a deposit constraint in the bank sector. And it's an additional constraint from the cash in advance constraint. So there's an exchange technology, which is called the cash in advance constraint, in these monetary RBC models. In the Lucas original model, you just have one additional constraint. But once you introduce banking to produce the exchange credit, you have this other constraint of the financial wedge. This is what creates the financial wedge. So you have to have this stuff go through the bank. You can't just like have a Walrasian auctioneer. So there's a cost of exchange. And what that does is the goods, the shadow price of goods is 1 plus the shadow cost of exchange per unit. Now, if you only use money, the shadow cost of exchange per unit would be the interest rate R, so it would be 1 plus R in a cash-only economy. But when you use exchange credit also, the inflation tax is not R. It's not 1 plus R. It's 1 plus something less than R. Because exchange credit enables you to avoid some of the inflation tax. So it's a weighted average of how much you use in money and how much you use in credit. And this weighted average is less than R. Okay, so this is going away from all the standard ways of doing. See, this is a problem. One time I presented it and people were interested in trying to understand what this whole exchange credit is. In other words, I would suggest that the profession has not been able to endogenize velocity in a consensual way. And this has led to dropping models, including money, and instead going to an ad hoc Taylor rule in a model without money. All because they couldn't solve the problem of endogenizing velocity in a sufficient way. Lucas and Soki did a cash good, credit good economy. And Narayan Cooker published a paper saying this doesn't match velocity well empirically. That's one well-known. Another well-known is the Baumol-Tobin inventory theoretic model, where you have a cost of a transactions cost of doing exchange and using the bank. There are a lot of varieties of the Baumol-Tobin transactions cost model. But see, what we're doing instead of a transactions cost is we're using the industry, like consider American Express, 50,000 people around the world. So we're doing the industry. It's not just an ad hoc transactions cost. That's the difference.
And what about the money in the utility approach that's also tries to endogenize this?
That's right. And so the money in the utility function was the first one, because that goes all the way back to Hicks. Hicks actually suggested that in his, I think it was Value and Capital. And of course, it was a static model, not a dynamic. And then Sidrowski in '67 made it dynamic, a whole general equilibrium model. It wasn't exactly right. Lucas corrected it in a 2000 econometrica paper. He did money in the utility function. And the other one that I didn't mention is the shopping time, which comes from Bennett McCallum, who recently passed away. And the money in the utility function, you can specify the utility function in any way you want. Like the way people don't get utility out of holding money. That's the whole point, is that it has no utility. So when you use money in utility function, you have to ad hoc specify the utility function. So there's no preconception of how to do it. When Lucas does it in this 2000 econometrica, that's the best one, the reference to look at. He does it in order to get a Baumol-Tobin constant interest elasticity of 0.5. So he specifies it in an exact way. He backwards engineers it so that he gets a constant 0.5 interest elasticity of money. You know, so you can backwards engineer it to get anything you want. Yeah. We end up getting a interest elasticity of money using this production of exchange credit that is more like a Kagan. You can also backwards engineer the utility money and utility to get a Kagan one, which, you know, the interest elasticity rises with the interest rate. you become more interest elastic as the interest rate goes up, unlike the Baumol-Tobin constant interest elasticity model. So thank you for that question. So this is also this exchange costs, okay, that you get in this. It could be a Baumol-Tobin model. Even like for example, even when they put money in the utility function, Bill Barnett did that to get his divisia. And Milton Friedman, they both talked about the user costs of exchange, this user costs. And so I was saying how this inflation tax, the effective inflation tax is no longer R. So that's also called the user cost of exchange. And it can be written as an interest differential. So that's how I'm going to derive it in this model. It won't be R, it will be R minus the producer surplus you get per unit of goods because you own the intermediary and you have an upward sloping marginal costs. So you end up getting, you don't use all of your resources when you produce the exchange credit. You don't use up all of the inflation tax. You get a profit, producer surplus that comes back to you. That's what RD is. So it's the dividend on your deposits. And because you own the bank, you get that dividend. So R minus RD, it's a nice way to write it because a lot of the literature has used this form of it. Okay, so we're going to, well, we can come back to this stuff. I'll just say that in the literature, you know, this Lucas 78 is the consumption-based capital asset pricing model that we extend. Buer and Canzoneri. So Canzoneri put bonds in the utility function. He let bonds have a transactions costs function through the utility because they gave utility. And you know, at the same time, they tested this model, and you know, I have this nice quote from Pat Kehoe and Atkinson that this doesn't work. The Euler equation in the standard models, Canzoneri showed, does a poor job of capturing the interest rate. Now, Duffy also, a 2023 article, uses the CAPN, and he uses alternative utility functions and things like that. And he also finds that you can't explain the real interest rate. And you know, Darrell Duffy, in finance theory, he's quite the authority. So that was interesting that even to this day, it remains a puzzle and something of interest in the profession. Okay, so the model, you have consumption C and X as leisure in the utility function. That's a constant relative risk aversion form. And you have your time constraint where LG is how much time you spend in the good sector. It's the portion of your time, you know. LQ is how much time you spend in the financial intermediary, the bank sector. Q for credit. The referee said, I strongly suggest you use Q. And X is your leisure. Okay, and so we had to follow the literature here and make it the timing right. So we have shocks U, V, and Z. U is the money supply shock. V is the bank productivity shock. And Z is the goods sector productivity shock. So there are three shocks. And A is the amount of money that you take into the asset market before the goods market opens. And so you have money, M, left over from last period that you bring forward. So you choose how much money to bring forward into the next period. That's why you lose interest on money. And that M is how much money you brought forward. And you get your bonds, whatever you had in bonds, you get the interest on that. And then you buy new bonds. That's what BT plus 1 is, a time period T. And you get a lump sum transfer T. Now, in the representative agent economy here, bond holdings are 0 in equilibrium. So that stuff cancels out. And if you think of it that way, then the A is the money that you brought forward from last period, and plus T, the lump sum transfer of money that the central bank gives. So this A plus credit, which is Q, and this is nominal term, so A is nominal. And P is the price of goods. And Q is the real quantity of credit. Money plus credit is greater than or equal to what you buy in consumption goods, the nominal price times C. This is the quantity theory equation. So then the next constraint, it really, it runs off the paper just a tiny bit. It really ends there at BT. So you can see the whole equation there. And, you know, this is saying that your income earned from labor, W is the wage rate, and L is the sum of your working time in the goods sector and the credit sector, the bank sector. So that's your labor income, plus you get from renting out your capital, you get your capital income. That's R times little k. Then you make new investment. That's KT plus 1. And so your debt investment is KT plus 1 is minus KT. So I have, you know, 1 times KT is where you get the minus KT. And then you also have depreciation of it. So the other things that you get in income are the dividends. So RD is this dividend rate, and you get it per unit of dividends. D are the dividends, are the deposits in the bank. Sorry, not the dividends. RD is the dividend payment, the yield on the deposits. And then you have money that you carried over and the lump sum transfer. This is all income plus the bond, the return on bonds. And what you do with all that income is you buy consumption goods, the next line, and new investment in capital, in money, in bonds, and you have a fee for exchange credit where PQ is going to be an equilibrium price of the exchange credit that will come out in the first order conditions to be equal to the interest rate. The marginal costs of credit will be the same as the marginal cost of money, the interest rate in equilibrium. And this is your government budget constraint, where the lump sum transfer is from the net bonds plus the net money increase. And then we have that this lump sum transfer is this money supply shock. So it's the increase in the money. And this is that constraint where I said that your income in the bank has to be greater than what you withdraw in deposits. So that was the new one, number 6, that I tried to motivate earlier.
So just a
Yeah.
clarifying question. So the bonds are government bonds?
Yes.
Okay.
So this is the 1 period government bond.
But then they don't necessarily have to be 0 in a
Well, you see, that's a tricky question. In the representative agent, without having all sorts of gimmicks, you the agent can't be a net borrower. You have zero net borrowing from the government. Now, if there are ways to extend this with a government wealth constraint, where you have, if you go to Lucas and Stokey 1983, that paper was the basis for inflation rate targeting at a low inflation rate. That was the result of a smooth tax. And there they build a government wealth constraint, and you can build up debt and then pay it off slowly over time, things like that. But in this model, when we're not doing that, there's just this is a standard result that, including in Lucas 1980, there's no net borrowing. But you could build it up, extend it, and make that happen. People do this in a lot of ad hoc ways, especially in the new Keynesian literature. It's a reasonable question. I always think of how to answer that myself. So in the recursive statement of the model, you have as the state variables, the capital stock, the money, the bonds, and then there's state S as the state variable of the shocks. And so now here it does run off the page a little bit. So you maximize the utility. I should cut that down a little bit. But you maximize utility of goods and leisure, which is 1 minus your labor, plus the discounted value of the expected next period utility, which depends on KT, MT plus 1, and what's cut off is BT plus 1. That's all that's cut off. Then you have your goods production. I didn't show you that production function for the goods sector yet. And so there's first line is the household problem. And then you do the goods sector and the firm problem, and then you do the bank sector. So in the goods sector, you have your production function that depends on labor and capital. There's a share of capital devoted to the goods sector and a share devoted to the bank sector. You know, and SG plus SQ equal 1. So I don't have that additional line, but that's what's going on here. That's what the SG is. And, you know, you maximize your profit and you get that the real wage is the marginal product of labor and the real interest rate is the marginal product of capital. So I don't include those standard lines here. And then the bank sector problem is completely new. So here you have a production function that includes the third factor, the amount of deposits, and that's this D. And it's still a constant returns to scale function because gamma 1 plus gamma 2 are less than 1. They sum up to less than 1. So 1 minus gamma 1 minus gamma 2 is something positive between 0 and 1. If gamma 1 plus gamma 2 do sum up to 1, then this drops out and you get no unique equilibrium between money and exchange credit. The model doesn't work and you're back to the King and Raffaello model. And so you pay your labor and your capital costs, that's KT. And then you have 3 equilibrium conditions because you're going to maximize with respect to the labor, the share of labor, the share of capital, and the deposits. Now, KT is decided in the consumer problem, but the share being used in each sector is determined by the bank and the firm profit maximization problem. So now you have in the bank problem, when you do the first derivative with respect to labor, you get that the real wage is equal to the marginal product of labor in the bank sector. And you can write this relative with L relative to D and this relative to D. And then you can see that this marginal product is gamma times the marginal product, which is gamma. Well, no, the marginal product is this whole thing, and then gamma times the average product is equal to the marginal product. So this is just the average product times gamma is equal to the marginal product of labor. That's a standard result. Gamma times the average product equals the marginal product.
You have only 15 minutes.
How many?
15. And you are just.
Okay. So then, let me just say this. So if you look at this production function, you divide through by Q, you can see that rewriting it this way, you get that L over D, so the labor per unit of deposits and the capital per unit of deposits, they're raised to the gamma 1 and the gamma 2, and this is the amount of credit per unit of deposits. And see, money is the amount of money you use per unit of deposits. So this is putting the credit, dividing it through by D on the same units as money per unit. This is making it per unit. Now, since gamma 1 plus gamma 2 add up to something less than 1, you have the production function yielding a rising marginal cost, because gamma 1 plus gamma 2 is less than 1. So then you can get your money demand and your credit demand. Q over C is your credit demand. M over C is your money demand. And then you get your velocity. So, okay, we do all that. And this is showing that the velocity rises with the interest rate in a near linear fashion, which Benatti et al. Find is consistent with US data. So this model is consistent with US data of velocity rising linearly with the interest rate. Now here is showing the marginal cost of credit, this upward sloping line, and that's the marginal cost of credit. And you see, if you only use money, you would, if this is the interest rate here, you would lose all of this. This would be the cost of the inflation tax. This would be, so when you use credit, you get back the producer surplus. So the effective inflation tax is only this amount. So it's less than R. So that's RD. The area, that's on my screen, it's red. That up there, it's not red. But this is RD. And the other area is R minus RD, the effective inflation tax. So here's where the asset pricing kernel includes this R minus RD in a crucial way, because you could see that this creates the wedge. If you compare, this is the wedge that you get. So you made me nervous now, Andras, that I'm almost out of time. And so now I'm going to be rushing, but I don't need to. So let's see, what did I do now? So if you look at this wedge, it's approximately equal to the change in the producer surplus. So you have to anticipate the change in the producer surplus. That's the wedge that creates the inflation tax avoidance that you have to anticipate, and is the model extension. There was one thing I wanted to show, which is how this reduces down to I don't know about that square there, but if you look at the second line, if RD is 0, then the 1 plus RT cancels out. And the 1 plus RT plus 1 cancels out. And you get back to a fundamental only model. So that's when RD is 0, you're only using money. There's no producer surplus from exchange credit. So from the second line, you can see that this cancels out, that cancels out if RD is 0, and you get your fundamentals only consumption and leisure for your asset pricing, and it doesn't fit the evidence. So that was the point I wanted to make there before going on. Now, this is the version where it looks like a Taylor rule. If you just write out the log linearization of that equation, you get that the log linearized interest rate depends on the forward interest rate times this omega, and it has a growth in money term. It has the 1 plus omega times this inflation expectation, the growth in consumption, the growth in leisure. So those are all the terms. But you can see why this looks like a Taylor equation, even though it's not. If this is 0.5, then you have 1.5 times the inflation rate. And you have, 0.5 times, like the forward interest rate. So it looks a lot like the original Taylor rule, but as extended to have, like Gali did, a lagged interest rate term. Of course, this is a forward interest rate term. But then the omega is the discount factor in the vector error correction model. And so I'm actually getting near the end. And the omega is that area, the producer surplus over the effective inflation tax, also discounted back by 1 period. So the omega is the degree of inflation tax avoidance. Because the producer surplus is bigger, the more is the inflation tax avoidance. So it's an endogenous variable. So the Lucas critique does apply in this case, because when there's a higher money supply growth rate or bank productivity in the exchange credit sector is higher, so that you have a lower marginal cost, you have more inflation tax avoidance in both of those cases, and omega goes up. So that's a Lucas critique application to the omega. So then you solve this forward to get this bottom equation of the real interest rate being this expected. And then we can take this forward. This is the final version of that, where omega comes in through this summation raised to the I on the change in the inflation rate. We can write that out so you see it's a change in the inflation rate, change in the consumption rate. So this comes exactly from the preceding formula. And this gives you, you can estimate with vector error correction exactly as did Campbell and Schiller. The difference is that we have more fundamental terms. They just had, the single term of the equity, the dividends over the equity price. We have the consumption and leisure, the inflation rate, all these other terms in there.
As far as I can see, you do the forward solution until t plus n only, not until infinity.
There's a transversality condition that I didn't write down here, where the that applies to that has to be 0, the end condition. You're right. There's a transversality condition that demands that discounted future interest rate is 0. The end as t goes to infinity.
So this means that you could just have infinity instead of m on the slide.
No. As n goes to infinity. you can do it as n goes to infinity. That's what the transversality condition looks like. No, you write it this way, but you allow n to go to infinity for the transversality condition. I should have included that. So this summarizes all the results. And then there's really, those are the last slides, you see. And this is just showing you both the dynamics and the co-integrating vector up here. And in the co-integrating vector in the baseline, you get just consumption and leisure being significant. So it's like a Fisher equation in the co-integrating vector. And then we do all sorts of experiments for robustness. And you know, what we find is that you really need to keep consumption in there. Leisure is very important also, obviously. But you know, doing it without consumption, the results become very awkward. And doing it without leisure is very doubtful too. So both are important. And you know, the way you estimate omega, if you go back to the previous equation, the first lag gives you on inflation, gives you the omega. So 0.54 is the first lag on the inflation term, and that is the omega. So and then we do it in all these different alternatives, and you get an omega very close to 0.5, like Taylor did in his original Taylor rule, although it had nothing to do with what we're doing. It's interesting that we got a similar result, 0.5. And we do two other ways of estimating this. We did what Cancenari did, and we reproduced the results, which was, it was different. We did it in using the whole policy solution for the interest rate. We got a high correlation, pretty high, between the historically backed out data for the interest rate and the model predicted interest rate. Different ways to do it. But the last two slides are just showing the co-integrating relationship. And the last experiment that we did is we allowed, so this is from 1959 to 2022. And what we did is we started, like, we decreased the size of the data sample by 1 year, started from 1960 to 2022, 1961 to 2022. And as you shorten the data sample, what happens is, number one, your omega starts to slightly rise because there's more inflation tax avoidance when you decrease the data sample. You get rid of the calm 59, 61, 62, and you get into the high inflation. You emphasize the high inflation of the 70s and the late 60s. And so your inflation tax avoidance goes up, this omega. And also, then in the co-integrating vector, you find that the inflation rate enters starting in 1962. So this is the real interest rate. You know, it shouldn't depend on the inflation rate in the sense as in the baseline model. This is a Fisher equation where the real interest rate only depends on the fundamentals. But if the real interest rate also depends on the inflation rate, as it does as you shorten the data sample, this is a premium. This is an inflation tax premium, in addition to the fundamentals. Because you remember, this is R minus the X ante inflation rate, pi t plus 1. So this is already, you know, subtracting the inflation rate out. You know, if you did the nominal rate, this would be, I guess, 2.04. So it's the real rate. And then we just did it for different monetary aggregates, and those are the last two slides. So that's all I have for you. Thank you.
Thank you very much. We have some time for questions.
So I guess I'm hoping that I'm convincing you that this is a way to estimate real interest rates in a way that's consistent with data. And we do it based on finance theory by setting up the model to create this first order difference equation like Campbell and Schiller did for the equity return. And then solve it forward and use vector error, which was quite new at the time, co-integration and vector error correction. So we're copying them, but we're applying it in this different context.
If you have a question, then thank you very much.
Thank you.
So, in one search.